What you see in many cases is what's called a short squeeze, where the traders do not have the ounces of gold that standing behind the contracts that they have. And so they have to rush to get it in order to cover. That represents a short squeeze. How well gold and silver have held up through all of this is noteworthy, to say the least. So yeah, I'm actually quite surprised and quite optimistic that this correction is behind us, and that the amount of effort needed to hold it down is something that has to have the banks on their heels and very concerned.
In today's news recap, China opens first offshore gold vault to attract global investors. The Shanghai Gold Exchange SGE has opened its first offshore physical gold delivery vault in Hong Kong in a strategic move to broaden international participation and amplify China's expanding role in the global bullion trade. Operated by Bank of China, Hong Kong Limited, the facility represents a significant move toward integrating China's gold market with the international financial system. By offering physical settlement in a globally connected financial center, the exchange aims to increase the appeal of its yuan-denominated contracts and bolster cross-border liquidity. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
You know, the conventional wisdom is that gold and silver drop due to easing of the Israeli-Iran tensions, you know, the signing of the temporary or hopefully the long-lasting ceasefire. But that's not what it was. I mean, you had options expiration, you have the end of the quarter, which options expiration was today, mind you, and I think it's interesting that they really had a hard time keeping it at or near $36 an ounce. And if you look at the amount of contracts that they had trying to keep it below that level, it's really quite incredible. There were 76,617 short contracts to keep the price down. It's an all-time record. And here it is. It's right back up. The demand, the physical demand at that level is extraordinary. But to see gold down $100 since June 12th and silver a buck lower, that's not a reaction to geopolitical events or a cooling of the narrative. This isn't a natural correction. It's a managed decline, and it started Sunday night, and it went all the way down to today. But we have, not only do we have the end of quarter and the options expiration, you have the July contract, which will go off the board, I believe, on Monday, the first day of delivery requests. And so we've been seeing tremendous deliveries come out of COMEX. I would expect to see that continue. Look, the prices were reacting long before any conflict had arisen in the Middle East, certainly the one that we're focusing on. But since President Trump was elected, you've had almost 820 tons of gold stand for delivery done again, and somewhere in the neighborhood of 9,000 tons of silver stand for delivery. The trend is not stopping, quite frankly, and you can see the amount of effort that the banks are using to keep it down. I mean, it's extraordinary when you figure each one of these contracts on silver are 5,000 ounces, and they're trading 76,617 contracts short to keep the price down. That reeks of desperation, and it reeks of stupidity, if you ask me, because you have a good portion of the world who is using that effort, that manipulative effort, to stand for delivery and rewrite the narrative. You could say the same thing is happening with platinum at the same time. So I think that how well gold and silver have held up through all of this is noteworthy, to say the least. So yeah, I'm actually quite surprised and quite optimistic that this correction is behind us, and that the amount of effort needed to hold it down is something that has to have the banks on their heels and very concerned.
In today's news recap, gold remains an attractive source of diversification. A survey of 75 central banks managing a combined $5 trillion of reserves showed that 1 in 3 intended to buy more gold over the next 2 years after stripping out those planning to decrease, the highest in at least 5 years. The report by the Official Monetary and Financial Institutions Forum, OMFIF, was carried out between March and May, a period of heightened uncertainty over the outlook for U.S. tariffs. After years of record-high central bank gold purchases, reserve managers are doubling down on the precious metal, OMFIF said. The dollar, the most popular currency in last year's survey, fell to 7th place this year, yet with 70% of those surveyed saying the U.S. political environment was discouraging them from investing in the dollar, more than twice the share a year ago, according to reporting by Reuters. The OMFIF survey underlines our view that demand for gold among central banks is likely to remain robust. Although gold has retreated from record highs in recent weeks, we continue to see gold as an attractive source of diversification. Our base case is for the metal to end the year trading around $3,500 an ounce, compared to $3,325 an ounce at present. Regarding the U.S. dollar, we expect sustained U.S. policy uncertainty to erode the belief in U.S. exceptionalism. We recommend using near-term dollar strength to reduce excess U.S. dollar cash by investing or diversifying into other currencies such as the yen, euro, pound, and Australian dollar. International investors should also review their strategic currency allocations and consider hedging U.S. dollar exposure in U.S. assets back into their home currencies. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new numismatics handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering U.S. coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
On one hand, it is the central banks. It's what it is to me more than, I mean, that's a good question. But what it is, it's that the gold and silver disappearing from the exchanges, that's the physical liquidity upon which this entire house of cards is based. And if you're pulling the liquidity out because it's standing for delivery, that's a problem. What you see in many cases is what's called a short squeeze, where the traders do not have the ounces of gold that standing behind the contracts that they have. And so they have to rush to get it in order to cover. That represents a short squeeze. So it is the buying of the central banks. It is the buying of the sovereign wealth funds. It is the buying of the biggest money in the world, the sophisticated money in the world, who is able to accumulate and stand for delivery, that is affecting the price at that level. And yes, it is exacerbated by these moments of panic covering in an environment where we continue to see delivery requests. And that's something that I think people need to really understand, that this is something that never, ever happened before. David Jensen does an amazing job on Substack of explaining this. He talks about, look, the LBMA is trading 200 million ounces of gold per day and 3.43 billion ounces of silver with a B per day. That's almost 4 times global mine supply per day, annual global mine supply per day, standing behind somewhere in the neighborhood of, I don't know, under 200 million ounces. That is the float. I think it's much less than that right now. So you're talking 12 plus times the float. What you're witnessing right now is a desperate effort by the West, who has always been able to easily manipulate the price of gold and silver through levered contracts, because no one ever challenged them by standing for delivery. And that's really the difference. And these deliveries continue to happen across the globe. So yeah, I think this should be looked at as a very optimistic and hopeful development where they have to expend that kind of effort to hold the price down, and yet it really didn't go down very much, didn't dip below 36, and if it did for a very, very short period of time, and here we are right back above it again. I wouldn't want to be as stupid and irresponsible as these banks are, having that kind of a short position in an environment where much of the world is challenging it through delivery. So yeah, it's to his question, I think a lot of it is short covering, but it's short covering because these players, whether it be central banks or sovereign wealth funds, are standing for delivery. That's what's different.
What do you think of Schectman's take? Do you agree with him? Is the big reset a reality, or is it all just bollocks? Post in the comments section down below your honest opinion and share with the stackers your gold and silver price prediction. Now, check this video right here because it's a perfect fit for you, and I'll see you on the other side.